But let me bring in ET Now's consulting editor Mythili Bhusnurmath to discuss with economists about their expectations from the union budget. Let's take a look at what they had to say.
I think I would say more neutral. In terms of the fiscal deficit, we think the target of 6.4 for this year will be met, and the government will bring that target down to set a target of 5.9% of GDP. Now, FY24 is a year where we think real growth will slow down, and therefore nominal GDP growth will be down. Therefore, the deficit coming down, but the quality of consolidation focusing more on capex, which is what we expect. I would say net is neither expansionary nor contractionary, but more sort of neutral from our standpoint.
There is no good year to present a contractionary budget. Whether it's a pre-election year or a post-election year, it's always a tough decision. But our sense is that this is probably a good year to attempt that tough decision. That's because of several factors. One is that on growth front, there seems to be a conflict between data and narrative. The data is supporting the fact that growth is still quite strong. The narrative is presenting some challenges ahead. The government should go with the data, not with the narrative. Second issue is that inflation stickiness in core can any day turn into a bigger challenge closer to election. So from a macro stability perspective, it's better to focus on fiscal consolidation, not stoking inflation, rather than going in for a stimulus at this point. Third issue is that our debt levels are still very elevated, so much so that interest expenses are now close to 40% of our total revenues. We can't get debt to GDP ratio even declining unless fiscal deficit is brought below 5% of GDP. So we have to understand that our starting point itself is very expansionary. So there is a need to consolidate now. And this is a year where we are going to get a big one-off from substantial subsidy reduction just because of certain factors that may not repeat every year.
We are looking at a fairly neutral budget, fiscal deficit of 5.9% of GDP, with a net borrowing program of slightly over 12 trillion rupees. I do think that the economy will slow. There is at least, if you look at our house view, there is a combined US and European recession coming. Lending rates obviously have gone up because the Fed is raising, the RBI is having to raise rates. So when you put this together in the context of an election, I think the government has to step up welfare schemes to some extent. It has to also give a free hand to the RBI to control inflation. I think that said, the government obviously will want to carry on with capex because the fiscal multiplier is obviously far higher than the consumer consumption multiplier, but over time. So I think that they could push on capex schemes where the outgo will take some more time, like PLI and so on. So overall, I think that this will be a play-safe budget, especially given the global concerns that we face at this point in time.